Hi guys, I hope everyone's well. So welcome to this month's webinar. It's the first webinar, as you know, of the new year. Everyone's really interested. We're having more and more people look to find out exactly what's going on with the property market. There was a lot of upheaval the last 3 months of last year. So we're going to dive into what we expect to happen this year. We were pretty spot on with a lot of our predictions, which is great. We didn't expect the mortgage market to go the way it did, obviously, and we certainly didn't expect inflation to get to where it is or where it was, over a sort of 10, 11%. But again, we got a lot of things right over the last few years. First of all, the fact that COVID, we thought that it would actually push the market up, not allow it to fall, which is what a lot of people predicted. Secondly, we said about the need for space is going to be a fashion thing. Therefore, the market will start to come back into sort of like the major cities, London, Manchester, Liverpool, Leeds, those kind of things. And of course, importantly, we did think that the market would increase last year. We didn't expect it to increase as much as it did. But again, we had another bumper year last year, albeit the last 3 months were about 2.5% to 3% of a fall. But let's go into what we expect this year. So, of course, if you like and subscribe these videos and you're watching it on YouTube, again, hit the subscribe button, hit the like button, and you'll get all the latest updates from ourselves. So let's have a look at the latest. Well, first of all, let's have a look at what happened, the crash that people are talking about. And we had a lot of people put the brakes on in terms of looking at potential property purchases and buying off plan rather than ready now, because they thought there was going to be an imminent crash. But actually, that can actually work in your favor. If there's a thought of something, and typically the thought is always worse than the reality, but if there's a thought of something, you can actually get some good deals out there from developers. So look, has it already started? Well, the first 6 months of last year, so let's wind back. The first 6 months of last year, we were up 8% year on year. We then started to obviously know a lot more about what was going on with inflation. It was really fueled by a lot of issues going on in Ukraine, Russia. Of course, that really drove the energy prices up and the cost of grain, therefore the cost of food. But also there was a lot of supply issues coming out of China, and people had more money in their pockets due to what was going on during COVID. Countries like the UK and US were simply printing money, giving it away. So inflation was always going to come to fruition. However, we didn't expect it to go up as much as it did. Again, there's two types, well, there's a number of types of inflation, but two that we always look at is obviously what you see on the daily news on a month-to-month basis. But of course, there's core inflation that takes out energy, takes out food, and actually that's sort of just around 6% at the moment. So it's actually a lot less once you take the energy and the food out, because the reality is it doesn't matter what interest rates are, it's not going to control the cost of food, and it's not going to control the cost of energy. That's simply coming from an outside source. But if we look at last year, once inflation started to get going, we started to see people, take a look at the property market with a different view. They started to think, well, actually, where are things going here? Do we think there's going to be a little mini crash? Again, we always said along, we don't think there's going to be a crash. We didn't think there was going to be any big impact on the property market. But we did think it was going to become a little bit stale, a little bit static. Now, that was excelled by the mini budget towards the end of September. And the last 3 months of the year, October, November, and December of 2022, we actually saw the market down 3%. However, we were still up overall over the whole year. So if we take 2021 and 2022, we still had a great 2 years in terms of growth in the property market. And January has bucked the trend. Now, we don't have the exact figures at the moment from like the land registry stats in terms of what's been sold, but we do have from Rightmove so far the fact that January 2023 bucked the trend, and we're actually 0.9% up on prices from what Rightmove are telling us so far early in the month. We won't get the exact prices until sort of the first week of Feb. But again, what Rightmove is saying so far is that January has actually bucked the trend, and although supply is still pretty much the same, demand is actually up. So what we are also seeing is more positive economic news. We've seen obviously inflation start to come back slightly, be pegged back, both in the US and the UK. We've seen the fact that everyone was talking about going into a recession. Well, the growth in November for the GDP was actually higher than expected. Again, wasn't setting world records by any stretch of the imagination, but it was in the positive rather than the negative. So there are a few things where we're seeing a number of green shoots, but more importantly, things aren't as bad as they've seemed. So what we've said all along is there's going to be a correction. Now, this is what a number of, I always say so-called experts is, no one's got that perfect crystal ball. And if they were experts, the actual margins for increasing and decreasing the property market wouldn't be as wide as they are. So to me, everything about the property market, whatever anyone says, is always a guesswork to a certain extent. They're obviously educated guesses, and we'll come to our educated guess in a minute, but they are still guesswork at that. So you can see here that if we look at 2022, you can see that Halifax had a 1% increase, going right the way through to Capital Economics had a 5% increase. Now, it was pretty much closer to what Rightmove and Capital Economics were predicting in terms of the 5%. Halifax were way out with their guesstimation. But if we come to 2023 now, you can see on the right-hand side, you've got anything from Hamptons being flat at 0%, right the way up to negative 12%, going back to Capital Economics right down at the bottom. So in the reality is no one can guarantee that, no one knows. Our view, and we're going to come to this in more detail a bit later, but our view is straightforward. The reality is that things that change the property market pricing is taxation, things like your stamp duty, interest rates, like we've seen already, interest rates increase, mortgage rates increase, that impacts it. And of course, legislation. And of course, there's liquidity with banks as well. Now, the thing that affected it in 2008 was, of course, liquidity with the banks. They put a pause on everything. So the reality is that really took the legs away from the property market. But we don't feel we're going to see that this time. Legislation is still on our side. Taxation, again, they changed stamp duty back in September, and they kept the stamp duty exemptions on certain properties back in September, from September. Now, but mortgage rates have, of course, affected it. So what's happened? Well, demand has slowed, but now mortgage rates are starting to come back. We feel that rather than this huge crash that everyone's thinking, or some people have been 15, 20% in the negative, we're thinking a small correction, but the reality is 3% of that's already been factored in. We think probably we'll be looking at another 2 to 3% negative before we start to rise to the end of the year. We personally think the year is going to be flat, maybe even pushing 1 to 2% of an increase, because we don't feel that the economics are there to have this major correction or major crash. We think the slight correction, but we actually feel by the end of the year, we could start to see some positivity. So as I said, this is the consensus on the right-hand side, but we've still got some positivity there. The reality is, as we always say, no one's getting anything spot on, as you can see from the 2022 forecast, even though the worst for 2023 is -12. The Bank of England sometimes come out with some fantasy figures like -30%, but that's never happened in the property market. We still believe it's going to be flat, if not maybe 1 or 2% of an increase. So we can then go to the next stage, which is have any area. So what happens if you actually aim for certain pockets? Well, take a look at this on the right-hand side now. So you've got you've got Nottingham, obviously increasing 10.1%. Someone's asked a question about the rental market, and we will come to the rental market, yes, towards the end of the presentation. So in terms of the Nottingham, you can see here that Nottingham, Manchester, Birmingham, Liverpool, Leicester, Leeds, Sheffield, it's the tried and tested northern properties, northern areas that are still increasing year on year. As we start to head down south, now London is way out there in terms of the pricing, but of course the reality is we don't think London's going to perform anywhere near what these northern properties will do over the next sort of 12 months or so. So we still feel that there are pockets of areas that are going to increase more than others. Now, also, one big thing to say is that doesn't mean that you just go and buy anywhere in Nottingham or anywhere in Manchester. It's actually key that when you're buying, you're picking out areas that have got better chances of going up. Let's take Manchester, for example. If you buy in an area such as Deansgate, or you're buying an area such as Islington, you've got more chance of making money in Islington or New Islington by that tram stop than you do in Deansgate, because Deansgate's already had its growth. There's only a certain amount of money that the house prices can go to until they become unaffordable. And the same with Nottingham. You've got areas like the city centre Nottingham, but what you probably want to be looking at is areas just outside, areas like Beeston, for example, which are 5 minutes away from the main city centre, but you're right close to the universities there, great for traditional lets, great for short-term lets, areas like that, which will be up and coming over the next sort of 12 to 14 months, especially as we know that there's a lot of government money and a lot of local council money going into those particular areas. But you can see here, as I say, whatever we look at, the top 10 bar a couple, are pretty much all pushing north. So the reality is we still feel that the north is the way to go. And Liverpool, we've been touting Liverpool for a number of years, and again, it's still sitting at 8.6%. Liverpool held the number 1 spot for the majority of last year, but again, it started to peel back very, very slightly. A lot of people say is, well, do I just sell up? Is the buy-to-let market dead? Well, not at all. The reality is that what you have to do is you have to compare it. If you sold up now, or if you didn't buy now, whatever your case may be, whether you have buy-to-lets or whether you're looking at buy-to-lets, what you have to look at is potentially, well, what would I be doing with that money instead? If you've got money sitting there, the choices are straightforward. Well, you either leave it where it is in the bank, and then you've got to ask yourself, well, is that something that is one, safe? If you're over a certain amount of money in the banks, obviously FCA only will govern that up to a certain amount of money. They'll only guarantee that. Anything over that, they won't. The next thing you have to ask yourself is, what are you getting on your savings accounts? Well, then you've got to ask yourself, well, maybe I'm better to put it in bonds. What if you do stocks and shares? And then what if you do property? So you've got to compare like for like. It's your money. You've worked hard for it. You've earned it. So you obviously want to make sure it just works for you now. So the reality is from our perspective, we look at the stock market and we think, well, that's pretty much at an all-time high still, regardless of what's going on. A lot of people have forgotten the stock market, but actually, if you look at the figures, we're pretty much at an all-time high in regards to the UK market. Some people have said, well, they might go and invest overseas in the US market. Potentially, that's an option. You could go and invest in the US market, but then what you have to look at is the exchange rate. You don't get very many dollars for your pound at the moment. So you could make 20% on the stock market over in the States, but you could lose 20% on your exchange rate. So then you're going to be flat. So maybe that's not the best idea. And then you start to peter through all of these different investment options. And what you then realize is there's not actually much out there in terms of to where to put your money to beat inflation. It then comes back to property. Now we're getting properties still, even on traditional lets, making between 7 to 9%. In Manchester, in a great location, right close to Old Trafford football stadium. That's on a traditional let. On a short-term let, 10 to 12% plus. Now that's your income. Add growth onto that. Even if you think the market's going to be flat this year and no growth, well, over 5 to 10 years, history tells us that the property market continually 5, 10 years long-term always goes up. So if you can make 8 to 10% income, then the growth is just a bonus on top of that. And we'll come to the fact that some people think the market's going to dip in a minute, and should they wait? We'll come to that stage in a second. So the reality is do we think that the buy-to-let market is dead? We certainly don't. Now, a lot of people might say, well, you're biased, but again, you've got to look at the facts. You've got to look at logical decisions when you're buying or when you're putting your money into an investment. And we still feel that the property market is going to be outperforming the majority of other investments out there. Mortgage rates, as I say, we feel that the mortgage rates are starting to come back. There was a bit of a mortgage war that we saw last week when a number of lenders cut their rates to try and compete. We feel that they could be heading back down towards 3% by the summer, maybe even towards the end of the year. But by the summer, we're feeling that we could be seeing mortgage rates back down to 3%, which is a long way from where they were in October, November of last year. And as we said at the beginning, core inflation, we're a big believer in, looking behind the facts, not just seeing an inflation rate and seeing it's over 10% and being made nervous by it. Look at inflation without the war. Look at inflation without energy, without cost of food, and then we'll get back down to core inflation, and you'll see that actually, around 6% is not actually that bad in the whole scheme of things. And again, the need for space has fallen. So what is happening now is a lot of people going back to city centres. They're buying in the city centres because, one, they don't need the space anymore. COVID is, although it's still there, it's not as prominent as it once was. No more lockdowns, so the need for space has fallen. So those areas of the UK are falling in prices. Oxfordshire, those kind of places where people went to go and get the space, they're now being pegged back slightly. But city centres are increasing because people want to be back in the city centres. And another key thing as well is smaller apartments are in vogue. 1 bed's over 2 beds, 2 beds definitely over 3 beds. Now, why is that? Because people are having to pay more for their energy. So the reality is they want somewhere which is going to be a lower cost to heat, lower cost to have electric, heat, whatever it may be. The reality is that the lower the cost of that, the better it is for not only property owners, but renters as well. So smaller apartments, that's where people are heading at the moment. And we've just completed on development in Manchester, and it's unbelievably popular. The average rental in the area is towards 750 to 800, and we're getting 1,100 to 1,200, well above the market rate there, because the smaller apartments are in vogue. And again, another reason why we don't think the market's going to fall as much as what people are thinking is only 28% of people that own property have got mortgages. And this is a big thing. The reality is if it's only 28% of people, well, the interest rates are only going to affect 28% of UK homeowners. So you've got a big number of people there. You've got 72% who have got, no mortgages on their property. That's a big thing that people are really missing. So the reality is that we don't actually have a bulk of the population on mortgages. So that's something that we've got to take into consideration as well. Now, can you still make money? Now, this comes to, we're going to run two side by side at the moment, and this is going to come to the rental side. So those of you that are interested in the rental side or ask questions on the rental side, we're going to come to that. Now, the reality is that many people, they stop buying when bad news hits the newspapers, whatever it is, they just stop buying and they don't do anything. That's actually the worst thing to do. If you look at times gone by, when would people have stopped buying in the stock market last? So if you go back towards March 2020, April 2020, people stopped, they sold and they stopped. But actually what history shows us, that was a great time to buy. If you could have got some stocks and shares in March, April 2020, when it crashed, well, the reality is that you would have probably made 50, 60, 70% and beyond on your money. But people didn't, because what they do is they panic, they see everything falling around them, and they just don't do anything. They don't react, they don't buy. So what should you be doing in the property market? Well, again, if there's negative news, it's very easy to not do anything. But actually use that negative news to your favor. What we're saying to you is bid developers down, because developers are reading the same newspapers that you are. So if you've got a property that's 200 grand, go and bid 180 for it. You probably won't get it, but you might get 190. So the reality is use the negative news in your favor and start to bid developers down. We'll help you with that, of course, but start to use that thing, the negative against the actual developer, get a bargain and rent it out and make money on it. It's as straightforward as that. So if we go back towards the comparisons here, there's two developments that we've completed on recently. Now let's have a look at both of these. We've got Paragon House in Manchester. Now this was one that completed literally over the last 4 weeks. 1 bed apartment, purchase price 160,000, some were cheaper, some were more expensive, but let's go an average figure. Deposit of 40,000, mortgage 120,000 at 5%. So you've got £6,000 a year, the cost that you've got to pay every single year for your mortgage. But bearing in mind, this is another key thing here, is that's not your money, that's borrowed money. So as long as you're making above 5%, then that's essentially someone's giving you money, you're borrowing it at 5% and you're making 7% on it. So you're making extra 2% on money that's not yours. The money that you have got to invest is your 40,000. If you went to go buy stocks and shares, you would only have 40,000 to put in. So your income and your profit would only be on your 40,000. You can't go to a bank and say, give me 120, I want to go and put it in stocks and shares. They would turn you down flat. So your mortgage at 120,000, 5%, £6,000 cost. The rent that we're getting on these properties, 1,150 a month, 13,200 a year. Take off your mortgage costs, it's going to give you an annual income of 7,800 a year. So based on your £40,000 deposit, which you've got, because that's what you've got to compare it to. You can't be looking at saying, well, actually, I've put 160,000 into it. The reality is that you only put 40,000 into it. It's paying you 19.5%. So that income of 7,800 based on your 40,000 deposit is 19.5%. That's what you've got to look at. Then we go over to Albion Mill. Now, Albion Mill, similar kind of thing, 1 bedroom apartment. The purchase price was 160 again, and it was dead on that. The rent for the client is 15,000 a year after cost. Now, this is skylit. So the difference between the Paragon example and this example, one was traditional let. So on the Paragon example, that's what we're getting on a normal 12-month traditional, what they called AST lets, assured short hold tenancy. Now, this is what this is skylit. This is what we're letting out through Airbnb and Booking.com for this particular property. Client purchased 1 bed property in Manchester, 160. It's now renting for 15,900 a year after costs. So the reality is when we break this down and when we look at what the client is making on this, this is a 24% return on the cash investment. Once we've taken out the mortgage costs, of course, and then we compare it against their 40,000, 24%. So there's very few investments out there that you're going to go and get 24% on your money, because it's not about what you've purchased, it's not about your 160 grand, it's your money, your cash investment. That's what you've got to work it out on the back of. So let's recap slightly. 2022, as we know, year like no other. It was really a game of two halves, basically. We had the first 6 months doing fantastically well, and then the next 6 months, it was pretty uncertain. But 2023 started off great. I think there's going to be a bit of a hesitation. People are going to see what happens. We've got inflation being announced. We've got next Thursday, I believe, there's a rate announcement. So are they going to leave it where it is? Consensus is that they're going to increase it by 0.5%. And we're going to see interest rates at 4%. But then also the consensus is that we're going to start to see them being brought back down by the summer, potentially pushing back to the end of the year. But either way, the consensus, we're going to start to see them come back down. We do feel that there's going to be pretty static. Doesn't matter if it's 2% up, 2% down. It's going to be pretty static, the reality, in terms of the growth. The year can be made successful by bidding on your property, getting a lower price, and actually making great income. So actually, even if you bid on the property and you get a lower price and your growth is static, you still make money because you got a lower price to start off with. As we said here, great discounts from developers. That's what you want to be aiming at. And again, off plan is the way forward. Why? Well, because mortgages are slightly more expensive at the moment. So if they're slightly more expensive from the mortgage side, well, the reality is don't get a mortgage now. Buy something that's 12, 18 months off plan, wait for those mortgages to come back down, and that's going to be the way forward. As I say here, you secure your price now, you get the discount now, but you actually don't have to pay anything for another 18 to 24 months. We're still getting solid income. Growth is just a bonus, in my opinion. If you're getting 19 to 24% income on your cash deposit, then again, you're making great income on that. You're making great gains. So now over to you guys. First of all, I want to answer the question that someone mentioned at the start about the rental market. The rental market is increasing. It's harder and harder to find properties, good quality properties to rent. There's talk of legislation changes, and this is where it's going to go in our favor, of older properties that don't have a great EPC rating being taken off the market from being able to rent, and any rating of a C or above is allowed. So if you've got a D rating on your property or an E rating on your property, chances are you won't be able to let that. So what a lot of people are doing is they're saying, well, actually, I want to buy a property, but it's got to be new. I want a C or a B rating or above, because the reality is I want to make sure that I can let it. So the first thing is the rental market is strong. And we know that because when we sold Paragon, and we sold Paragon back in December 2021, and it completed in December 2022, we were predicting rents of $850 on a traditional let. And we're actually getting rents of $1,150. It's much better performer than we thought it would be. We're always a little bit conservative, but again, rents are increasing at a rapid rate. Given the cost of the energy, short-term let's still giving 10%. Good question. Yes, it is. What you've got to look at with the short-term lets is people are rarely in there. That's the reality. A lot of people think that short-term lets get high energy bills, high wear and tear, but it actually doesn't. What do you guys do when you go away, whether it's a city break or whether it's a longer term break, especially a city break? You go in, you dump your cases and you go out. You're there for 3 days. You're not going to spend 3 days. You're not going to go to a 3-day hotel in the middle of Manchester and not go out. It defeats the object of you going there. So the actual short-term let has less wear and tear than a traditional let. And the energy costs, the reality is it won't really impact it, because what we do is every time we go in, we make sure everything's off. So you've got the cleaners going there, double checking everything's off until the next let. But the reality is the cost or the income that you're going to get in will comfortably outperform whatever cost of energy rise is going to be. When we consider taxation on rental properties, brackets, I believe 40%, what is the return on the buy-to-rent properties? Good question. Now, look, legally, I have to say that I'm not a tax advisor. I can't give you tax advice. If you're doing it like that, if you're turning around and you're not taking any tax advice and you're just putting it in your personal name and you're paying 40% tax on it, then the reality is that that's going to really eat into your income. Let's go back to one of the examples before. If you've got no wrapper to put your property in and you're getting 13,200 in, you don't even have the benefit anymore of getting taxed on your profit. You're going to get taxed on your gross income. That's criminal. That's the worst way to do it. And I know some of you have probably purchased properties And the reality is that the taxation legislation has changed after that you've purchased them. But there's so many advantages of actually putting in a limited company. And again, I have to say I'm not qualified, so my advice would be to speak to a tax advisor. But if you put it in a limited company, you're paying 19% tax. You could pay other people and potentially take advantage of their 12,750, whatever it is, tax allowance. Plus, on top of that, the reality is that you only pay your 19% corporation tax on your profit. There are other potential advantages as well. Rather than capital gains tax, it still comes down to corporation tax. But that's really someone for an accountant to speak to. But yeah, I agree with you. If you're just sitting there and you're a 40% taxpayer and you've got buy-to-let property, it's probably not the best thing to do. It's the same if you put money in the stock market, then you're going to pay high tax on that as well. So what do? Well, you might wrap it in a SIP or you might wrap it in an ISA. It's the same with property. You need to wrap it in something that's going to be advantageous from a tax perspective. For new builds with Flambard Williams, what would be the minimum deposit? Again, we don't dictate. That's a really good question as well. We don't dictate. We've got some at the moment which are only 5% down. We've got a couple coming up which are only 5% down, but there's monthly payments which brings you up to the 25 to 30% level. We've got some that are 10, 15% and some that are 25%. Just depends on the actual property that you're looking at and the area and the developer. And look, let's be honest, the developer is going to get charged as much as they can get away with. But that has come down over the last few years. Back in 2014, 15, it would have been 50% on some of them that you'd have put down. But now, as I say, it could be anywhere from 5 to 25%. Next question. What's happening with St Anne's development in Liverpool? Stuck for a couple of years. Latest update. Yeah, really good question. So St Anne's development was one that was launched in 2019, I believe it was, November, December. COVID come along. It's been a nightmare a couple of years. Developers have been, well, not going to, do this with rose-tinted glasses. They've been pretty pathetic at getting on site. And in my opinion, they've not paid the attention to it. There was a letter that went out a couple of weeks ago. If you didn't get that letter, send me a personal email. I could get that sent over to you. But yeah, in St Anne's, they're waiting for the Liverpool Council to agree a Section 106 figure. That has to be paid. And then they can potentially get on site. If they don't get on site at that point, then again, I think the writing's on the wall as far as that development's concerned. In terms of the long stop date, yes, at the long stop date, that's when your solicitor can ask to rescind the contract. Do you have an update on investing in Liverpool? In terms of what? In terms of, is it a wise thing to do? So Liverpool has got some great options in it. There's a couple of things happening in Liverpool at the moment. As you look at the map, you can see on the docks, you've got this Liverpool Water Scheme, which is like a £5.2 billion, I think it is, scheme. And everything around there is going to be phenomenal. It's set to be phenomenal. It's a 10 to 15 year scheme, but it's set to be absolutely fantastic. We've got a couple of options there. Liverpool as a whole is one of these anomalies, which is if you get the right development, it gives you fantastic rent. But there have been a few issues with a number of Liverpool developers where they just haven't got around to building. Now, why, I don't know. I don't know whether they're taking the money and doing whatever with it, but the reality is they would have probably made more money if they got the thing built. So you've got to just we're a little bit more wary of Liverpool than what we were a number of years ago because of a number of developments that haven't come to fruition. But yeah, in terms of if you get the right development in Liverpool, we've got no doubt it's the right, it's still a great city to invest in. Well, look, guys, that seems to be all the questions asked and answered. Just leaves me to say, look, have a lovely rest of the week and a good month and obviously a great 2023. And anything you need, you're in, just get in contact at any time. You take care. See you soon. Bye-bye.